So the stock market has fallen around 10% this year, and it always feels bad to see your money disappear from the account. But before we start selling in wild panic, it's time to think about what this really means and why it's happening. I know that many of you just started with stocks, and after 2 great years, we've gotten pretty used to that the stock market should always go straight up by 20-30% per year. But this is far from the norm, and I think you know that too. The most common condition for the stock market is to rise, but not in a straight line. A small decline of around 10% actually happens most years, even though the stock market later ends up on plus for the year. So there is no need to panic yet. And quite regularly, there will be slightly larger crashes of 20% or more. Historically, they've often come around every 7th year. These are some of the rules of the game that you have to get used to if you want to invest in the stock market. Maybe we're in the beginning of a crash now, maybe not. So lately, many have been shouting that the worst stock market crash, the mother of all crashes, is here as soon as the stock market has gone down by a mere percentage or two. We live in a time right now when everyone is competing for our clicks and our attentions, whether it's the newspapers or YouTubers, and you get the clicks by presenting horror headlines. In reality, of course, this is not true. Really, no one knows. No one knows when the crash will come. Not even Michael Burry, not Cathy Woods, not Ray Dalio, and not even me. I know, it must come as a shock to you, but try to breathe. So, since no one can predict the future, one thing is still certain: the crash will come sometime. So, it's best to think through now what you would do when it really comes. So here are some of the rules that I invest by and that I think works well in occasions like this. The first one is, do not panic sell. Okay, you've heard it before, but it's so hard to follow when we're in the middle of reality. But don't sell in panic. Sell if you have a strategy that tells you that it's time to sell right now, but don't sell because you think that you will be able to buy again at the bottom. It's very difficult to hit the bottom, and most people end up losing money instead of gaining something on trying to time the market. It's absolutely not obvious when we reach the bottom. I don't know if you were into stocks during the crash of 2020, and if you remember what it was like back then. I myself had some money, and I was thinking I should buy some more when we got to the bottom. And then the bottom came, and it started to rise again. But not everyone agreed that this was the bottom that we saw. Many talked about a bull trap or a dead cat bounce, and that we would continue down even further after a short period of time. So where the bottom is can really only be identified afterwards. And of course, I didn't manage to hit the bottom either. So don't sell because you think that you will have time to buy back at lower levels when it turns around. It is super easy to sit and look at historical stock charts and say what you would have done and think that you would also have succeeded to do it, but in reality, you have no idea, and no one else has it either. It can turn around now. We may have already seen the bottom, but it may continue down as well. Therefore, it has been proven best to just stay invested all the time and not try to time the market. In fact, this is where we small investors lose the most money, trying to time the market. Many of the stock market's best days also tend to come close to the worst days. So selling right after a big dip might mean losing out on a big rise shortly afterwards. Number 2, think about your level of risk. Does it still feel hard to see money disappear? Then I think you should think about whether you actually are investing with the right risk level. Of course, it's always a little bit hard to see everything in red and lots of money disappearing. And when you have slightly larger sums in your account, several months worth of salary or more can disappear within just one bad day. I'm the first to admit that it's not always easy mentally to just take this in, but what I mean is that it shouldn't feel so hard that it takes over your life, that you can't sleep due to anxiety or something like that, for example. What you have invested in the stock market today should not be money that you need to manage your everyday life right now, to be able to pay your bills, buy food, etc. This should be money that you don't intend to use for at least 10 years. Is this not true for you? Do you feel very worried and have invested money that you need in a short while? Then you probably have taken on a too high risk. So what should you do then? Think about how much you could handle seeing lost in a crash. During historical crashes, The stock market has usually gone down between 20 and 50%, but as we all know, historical returns are not a guarantee of future returns. So if things go bad, it could go down even more. And these are numbers for the entire stock market. Of course, each individual stock could go down more or less. And often we see certain sectors hit extra hard depending on what caused the crash in the first place. In any case, I think you should be comfortable with at least losing 50% in the short term. Otherwise, think about your risk level and don't invest all your money in the stock market. So what else should you do then? There are no really good alternatives right now. At least I don't think so. Traditionally, you would have put some in bonds instead, but the interest rates are so very low right now, so it doesn't really give anything. And once the interest rates start to go up, the bonds will go down, at least initially. It may seem a bit backwards, but say that you have invested in a loan. That's what the bonds are, right? Different loans. So, say that you have invested in a loan with 1% interest rates, and then the interest rates goes up to 2%. The interest rates of the loan that you already have is set and will not go up, but new loans are taken out all the time. So, all of a sudden, there are loans with 2% interest rate that you can also invest in. So, everyone will want to invest in the loan with a higher interest rate, right? Because it gives a higher return. And your loan with only 1% interest rate will therefore be worth less, and no one will be interested in buying it. So a bond fund naturally contains several different loans, and depending on whether it's a fund with loans with shorter maturities or with longer maturities, it will take different lengths of time for the fund to replace and get rid of the loans with the lower interest rates, which are not so attractive anymore. So then we have gold, which traditionally has been a good preserver of value. I myself, I'm not a big fan of gold, as I don't like assets that are basically useless. So a share is of course a part of a company, and at least in the long run it is thought that the company will make money and generate profit for its owners. But gold almost only has a value because we humans like glittering things. Gold is quite useless otherwise, and it's not used as much as other metals either in the industry, for example. But as long as everyone agrees that it has a certain value, it still has. So I would not buy crypto either as an alternative if you think that it's difficult to see the stock market go up and down, because in itself, crypto has a much higher risk than stocks and it's much more volatile. And also, Bitcoin, for example, has plunged along with the stock market, even though they're not super correlated. Yeah, in any case, there's no great alternative right now, so maybe putting some of your money just in a bank account with some interest rate at least can be just as good right now to lower your risk. Number 3, if you can still stand the volatility, buy more on the way down. Try to see this as a good opportunity instead of something bad. Try to turn it into something positive. No 15-year period since 1926 has given a negative result, and hardly any 10-year period either. So if you had put your money in the stock market in any time after 1926, if you only waited for 15 years, you would always have gotten a positive result. So you would have had more money than what you would have put in. This is why it's said that you should have a long-term savings horizon if you want to put your money in the stock market. And if you invest long-term, it's actually a good thing that the stock market goes down, because now you get the chance to buy shares cheaper. So take the opportunity to buy more on the way down, even if it feels hard to see the money you deposit disappear immediately. Because if you thought that a share that cost 100 a month ago was a good buy, it must be an even better buy at 90, provided that nothing else has changed for the company. And many individual stocks has fallen more than the stock market as a whole, so there could be some good buys right now out there. And don't pause the monthly deposits if you have such ones. It is a very good strategy to invest regularly and practice dollar cost averaging. If you deposit the same amount, maybe say 100 every month, it will automatically be the case that you will buy fewer shares when the stock market is higher and more when the stock market is lower. And this will benefit you in the end. Number 4, do not log in all the time and check the value of your account. This is a rule that I really live by. It simply isn't fun to see red numbers and 1,000, 10,000, 100,000 or millions disappear from your account in a crash. Think how much you could have done with this money instead if you've only been smart enough to take them out beforehand. But now they're gone. I think it helps a lot not to see the misery. As long as you have followed my advice and only invested what you can afford to lose, you will still manage. Look around you and see that you're still quite well off. You have a home, you have food, you have your health, and everything else that makes your life fun to live. Don't focus so much on your investments right now. It will soon pass and they will go up again. To be honest, I actually don't know when I last logged into my account. I just reached a new milestone and now I've probably gone under that again, so I have no big desire actually to see it right now. It also helps that my bank app is incredibly slow on my phone. We're working with an iPhone 6 here, so maybe that's why. So this is a bonus tip. Switch to another phone and you will not want to log in at all the time either. Number 5, go over your strategy. This is actually a good time to think about this. If it feels difficult, it may also be a good time to go over your strategy. I think a good strategy should hold in all situations. And it should be one that makes you want to invest regularly, whatever happens. Also make sure that you have a good diversification in between different sectors and industries. Even if the stock market in general declines, certain sectors are often hit harder. We had the IT crash, for example, at the turn of the millennium, when technology stocks went down more. We had a financial crisis in 2008, and in 2020 airlines and hotels and such were hit harder. Therefore, make sure to not only invest in tech stocks, for example, but try to have an even distribution between several industries and several stocks, of course. Something that might be interesting to look at right now are value stocks. That is, stocks that are lower valued. Value stocks historically have outperformed growth stocks. The growth companies' values are based more on future earnings. And now that the economical growth appears to be slowing down a bit and inflation and interest rates are rising, their values are written down. In the last decade, however, growth stocks, especially in the US stock market, have outperformed value stocks. But that might be changing right now. There are many growth stocks in the tech sector, for example, that have had very high valuations for some time now. Growth companies are often dependent on financing in the form of loans, and with higher interest rates, these loans will cost more for companies and be harder for them to take out. At the same time, a lower growth rate of the economy means that they will not grow as fast as previously thought, so then the prices for these stocks go down. And perhaps most importantly, what do I think? A random person on the internet who for some reason thought it was a good idea to start a YouTube channel. The stock market is always upsetting about something, and right now it's higher inflation and the unrest around Ukraine and Russia that are the most pressing issues. If the inflation does not fall back on its own, central banks around the world will need to raise interest rates to calm the economy, because what we don't want is a rampant inflation. One way to control the inflation is to raise interest rates. Effectively, this means that money will cost more to spend, and spending will therefore fall back. Companies will find it more difficult and expensive to take out loans to finance their operations, and we, the general public with loans, will have less money in our wallets to spend because more of our income will go towards interest rate payments. So we will not be able to spend as much on products from companies, so thus the economy will slow down. For many companies, higher interest rates will therefore mean lower profits. But of course, there are sectors such as the financial sector that may also benefit from higher interest rates. So what happens to the stock prices is also very much about what people expect to happen and what happens in the end and whether it's in line with expectations. And as for Russia and Ukraine, I really hope we will not see more. So what do you think? Is the stock market going down further, or did we hit the bottom? Share your thoughts in the comments below. And keep watching this video if you want to know more about what not to do with your stocks. And I'll see you again next time.